Hello and welcome to Star USA Training. Today is February 21st and we'll be talking about USMCA and other FTAs. We are recording this webinar. The slides and the recording and all other materials will be made available after the broadcast. If you're watching this on YouTube, there should be a link in the description below to get a copy of the slides and any of the additional materials that we use. All participants are currently muted. The Q&A feature is available if you have questions. I will answer questions throughout and I'll take more at the end. So please feel free to submit those. And this session is eligible for 1 credit with the NCBFAA. So send an email to train@starusa.org after the webinar with your ID number and we'll get that submitted for you. Just some quick background on me and Star USA. My name is Michael D. Easton. I am the president and general manager of Star USA. I'm a licensed customs broker. I've been in the business for nearly 20 years. Star USA, company that I work for, we've been in the business for more than 25 years. We are a trade compliance consulting, advice, training, and services company. And we specialize in all manner of international trade, both importing and exporting. If you ever have questions, feel free to send us an email and please use the train@starusa.org. USMCA and other FTAs, the first segment of this is going to be focused on preparation and understanding what the agreement is, what agreements are in general, and how to kind of acclimate to them and provide you that baseline of requirements for how to qualify your goods and the methodologies and practices for doing so during part 2. So again, please feel free to ask questions as we go through. So for preparation and understanding, our objective here is to understand the underlying frameworks, core concepts, and mechanisms that drive free trade agreements. And the 3 elements of those that I really want to stress aggressively during this session is to recognize the system of checks and balances that is in place. Part of that is knowing what the rules say and knowing what role you have in the transaction, whether you're the importer, whether you're the certifier, whether you're the producer. And also recognizing what the other players in the transaction, what their roles and responsibilities are under the rules. You also have to know where to find the rules, using the rules as a reference point, the actual text of the agreement, the general notes, the HTS-US, all of those elements are essential to being able to navigate your responsibilities throughout any free trade agreement. I also want you to understand, coming out of this for sure, what the term originating means. It has a different definition than other terms used within international trade compliance, and I want to make sure to impress that upon you later on in the slides. And then lastly, the importance of the HS classification, the accuracy that's required for knowing the classification of both your finished good and your raw materials to help you make USMCA or other free trade agreement determinations. HS classifications are essential to that process. The U.S. currently has 14 active trade agreements in place with 20 different countries, and you can kind of see all 20 of those countries here on this slide. We're going to be using USMCA as our entry point into understanding FTAs, both because USMCA is the largest, most significant trade agreement in place for the U.S. today, and also because it's the most recently negotiated trade agreement, so it is the most updated. So I will be talking largely through the lens of USMCA. A lot of the same mechanisms apply to all the other trade agreements, but the rules definitely vary within each agreement and to certain degrees of specificity, particularly when looking at HS-based rules. But if you do have questions about the other trade agreements, please feel free to ask those. I'm happy to address them either directly or following the session if I don't get to it during this piece. For anyone out there that is aware of the Japan-US free trade agreement, I'm not including that because it's not ratified by Congress and it is very, very limited in scope, only applying to air conditioner parts, it looks like. So if you have questions about that US-Japan free trade agreement, you can wait until something else develops on that front, but right now it doesn't look like there's going to be much. Okay, so looking at the USMCA. USMCA establishes the parameters for free and reduced trade when trading originating goods between the member countries of US, Canada, and Mexico. And USMCA goes by many names. I live in the US, so I call it USMCA. But if you live in Canada, you're going to call it CUSMA, C-U-S-M-A. And if you're in Mexico, it's going to be TMEC. And the explanation for those different naming conventions are on the slide there, but effectively it's each country putting themselves first in the acronym or the initialism. On the left-hand side, there are links to each of the text sources for the agreement. Each country publishes the text on the web. In the US, we publish it via the US Trade Representative, and we also have many of the rules published in the HTS-US General Notes. Canada publishes it on their Government of Canada website in both English and French, and Spanish version is available on the Mexican government website as well. USMCA is also referred to as New NAFTA or NAFTA 2.0. The term NAFTA appears throughout the U.S. import regulations periodically for rules of origin and various other segments, referring to the NAFTA countries as U.S., Canada, and Mexico. So the term NAFTA is not fully gone, but the North American Free Trade Agreement is not currently in effect and likely will not be, but the word still exists. USMCA came into force on July 1st, 2020, and it renews on the 6th anniversary following the last renewal date. So our next renewal date is July 1st, 2026. The agreement expires 16 years after the date of entry into force. So June 30th, 2036 is the date of expiration. If they fail to renew in 2026, the countries will meet annually each year until 2036 in order to recertify to renew the agreement, or if they do not reach an agreement over those 10 years of meetings, then the agreement will expire in 2036. That's kind of how they have it set up to maintain active status between the countries and to ensure that any changes in regimes won't affect the immediacy of there will be immediate changes to the agreement just from a change in leadership. Some of the core mechanisms of the USMCA, focusing on claims that can be made by an importer based on a certification of origin completed by the exporter, producer, or importer. So the importer makes the claim upon the importation of the goods, but it's very, very common for exporters and producers to generate a certificate. And that certification that they generate is then used to make a claim by the importer. There are mechanisms in place within the USMCA that were not in place for NAFTA that allow the importer to make a claim based on a certification that they prepare. So the importer can prepare their own certification. It's generally not recommended, and it is the least defensible version of a certification, but it is a mechanism that does exist within the agreement. The claims do not need to follow a prescribed format. Some of the questions submitted before the webinar kind of asked what the form and format are. There is no specific format or form required. Unlike the NAFTA, the CBP Form 434, that existed as the only official certification document that you could use. Under USMCA, you can use any piece of paper that contains all of the essential data elements spelled out in Annex 5A. We'll look at those data elements later on, but I just want to kind of impress that there is no you must use this form kind of requirement. What that has led to over the last couple of years is many companies having a variety of different formats and requiring for their own compliance practices and internal procedures and protocols that you complete the certification on their version of this document. So it's not been awesome navigating through all of those different versions and formats, but we have found that many companies are quite flexible in terms of what they're willing to accept, as long as it contains those essential data elements that are spelled out in 5A. You can put a claim on an invoice. I don't recommend that, but any other document, and usually a standalone document, is the recommended version. The USMCA rules are product specific. The rules of origin are based on HS classification and usually ranges of classification to the heading or subheading level. I don't think there are any chapter based rules in the USMCA. They're always heading or subheading based. The sections and chapters may also have additional rules that apply to all products within those sections and chapters, regardless of the heading or subheading. Those special rules precede the product specific rule. So you won't see it spelled out when you just drop directly to your classification. You'll have to move higher up in the agreement to the section or the chapter to see if there are any special rules that apply. We'll take a look at some of the special rules in the back half of this session. And then lastly, the verification mechanisms. These aren't substantively different from what they were under NAFTA, but the way it works is the country of import's customs administration may conduct a verification on any claim via written request seeking information or documents from an importer, exporter, or producer by conducting a verification visit to the premises of the exporter or producer to observe the production process. They can follow the textile-specific verification rules under 6.6, or else any other procedure that is agreed to by the parties being the countries of US, Canada, Mexico, not the companies that are making the claims. Again, this isn't wildly different. The most common mechanism for verifying claims starts with inquiry or a questionnaire. And these questionnaires can come from to a U.S. company that can be issued by either U.S. Customs or Mexican Customs or Canadian Customs. So they can send a questionnaire directly to a U.S. business that has made a USMCA claim, either as an importer or as more likely an exporter to their country. And those questionnaires need to be taken quite seriously. There was a question before the session about how to demonstrate and how to handle audits. In our experience, there is never enough information that you can give to the customs administrations of the foreign governments to justify your claim. There's no such thing as too much. You definitely want to over provide in terms of your evidence for how you verify your claims, how you can defend them. The concept of substantiation within the trade agreements is very, very important. You must be able to use documents to prove that your claim is valid. And if you cannot produce those documents, then you have not met the requirements of the agreement. Part of the agreement includes having those records and being able to produce them upon request. And those written requests seeking information or documents is that request. So hopefully, as we kind of look at the methods and practices for adhering to the USMCA rules, the concept of having documents to prove everything you're saying should be kind of understood, even if I don't call it out specifically. Or if you have a question about it, what kind of documents work for these sorts of things, feel free to ask. I'm happy to dive into that. But record keeping is extremely important under free trade agreements. Some of the key roles defined in the USMCA, and again, using USMCA as the lens for other trade agreements because they go a little bit further than past trade agreements in ensuring that the language is understood by everyone reading the agreement. The parties defined within the USMCA include the member countries, Canada, Mexico, and the USA. Those are the parties. So anywhere you see the words, the parties in the text of the agreement, they're referring to Canada, Mexico, and USA. They are not referring to the shipper or the exporter or the producer. The term certifier refers to the entity who prepares and signs the certification. And that's going to be the producer, the exporter, or the importer. It can only be one of those three parties. If you are not one of those parties, if you're an intermediary somewhere between, for example, the producer and the exporter, you're a distributor, then the certification may not pass muster for eligibility under USMCA. Producer just basically means the manufacturer. This is the party that actually produced or manufactured the good. The exporter is the entity delivering the goods to another party in a different member country. Generally, this is going to be the same as the USPPI within the US export regulations. 15 CFR section 30.1 is where that USPPI is defined, but that's the entity that's basically exporting the goods. Importer is going to be the entity receiving the goods from another party in a different member country. And generally, this corresponds to the definition of FPPI, the foreign principal party in interest defined in the US export regulations. Those correlations with the U.S. export regulations are just kind of for reference for those of us in the industry that know those regulations and are familiar with those terms, USPPI and FPPI. But otherwise, knowing who the exporter and the importer isn't an esoteric thing. It's fairly straightforward. The agreements do not define brokers, forwarders, suppliers, distributors, resellers, or any other third parties that are in the mix. So you're really only working with the producer, the exporter, the importer, and one of those is going to be your certifier. This one here, this point that I want to make is to ensure that everyone hearing me talk right now understands that the term U.S. origin is not the same as USMCA originating, and that term is not the same as made in USA. These things are not interchangeable. If a good is origin Canada, that does not mean that it is automatically eligible for USMCA. There is a different standard to meet when it comes to meeting the country of origin versus originating under the agreement. In the US, the origin rules are spelled out in 19 CFR 134.1b, meaning the country of manufacture, production, or substantial transformation. There are special rules for applying origin to the NAFTA countries, US, Canada, Mexico, that are in congruence with the text of the USMCA. And there's also an informed compliance publication on rules of origin determination within the US, and you can refer to those. But US origin, or origin generally, is not the same as originating under the USMCA. Originating under the USMCA is codified under Chapter 4 of the agreement, and it is also spelled out in 19 CFR section 182.61, where it goes to the rules of origin for USMCA. And effectively, you must meet the rules specified in Chapter 4 of the agreement, is what it says. And then lastly, we have the Made in USA standard. Just because you have a good that's origin US or is USMCA originating doesn't mean you're rising to the standards set out by the Federal Trade Commission, the FTC, of made in USA. They have new rules in place for made in USA labeling. I think those are actually in effect now. But it basically states all or virtually all content is made in the US. And that's a very, very different universe. So just make sure that you understand that the lowest threshold to meet is origin. The next highest standard is originating under a free trade agreement. And then generally the highest standard is made in. And all separate tests for each of those. If you ever need to explore those further, feel free to give us a shout. And then lastly, again, HS classification plays a critical role in FTA qualifications. When we talk about HS classification in the context of trade agreements, we're talking about the 6-digit classification, the WCO, World Customs Organization, 6-digit universal standard in place with all countries. We're looking at that 6-digit scope. We're not worrying about the 10 digits of the importing country or the exporting country or the variance that occurs within those. Most of the rules are going to be either 4 or 6-digit based. There are some rules that break that mold, usually as very, very specific outliers, but in general, when preparing certifications, when looking at your documents, when trying to meet the rules spelled out in Chapter 4, you're looking at the 6-digit level. And when talking about HS classification, you need to be understanding that we're talking about HS classification of the finished goods, the goods that you're actually directly importing or exporting. These are going to appear on the certifications of origin, and they're going to form the basis for meeting the qualification standards under tariff shifted region of value content. But you also need the HS classifications for the raw materials. If you're the producer of the good, in order to apply the USMCA or trade agreement rules, you need to have HS classifications on your bill of materials or on your raw materials to know if you're correctly applying tariff shift or region of value content methods. These concepts of having traceability in your production process form the backbone of that USMCA record keeping requirements, and is one of the pitfalls that many people don't recognize when getting into trading their goods under USMCA, not realizing that they need to have backup for the actual production process. And then lastly, I want to make sure you understand that penalties can apply. You do not have to claim USMCA or any other trade agreement on goods that you import or export. You are not required to, under law, to take advantage of the trade agreement. In fact, the trade agreement is for minimizing duties. And you want to recognize that by taking advantage of the trade agreement, you are agreeing to comply with the requirements. And non-compliance, therefore, has a penalty associated with it. In the US, we use the negligence, gross negligence, and fraud standards that are codified under 19 USC 1592. Each country has their own set of rules and penalties that apply for violations of import or export laws. And within the context of a trade agreement where there's multiple countries involved, the violating company's country is the one that's going to assess the penalty. So if you're in the US and you violate the rules, it's going to be US Customs that assesses the penalty. You won't be subject to Mexican customs penalties or Canadian customs penalties. If your company's in Canada and you violate the rules, you'll be subject to CBSA penalties. Within US Customs and import law, there is a protection from penalty if you submit a prior disclosure, basically protecting yourself by voluntarily telling Customs that you have made a mistake and that you have corrected it. You can be protected from penalty. You won't be protected from back duty that you should have paid when the goods were first imported, but you can be protected from the penalty provisions of this section. Okay, before we hop into the next segment, a couple of questions here. We have one question for, is there a dollar value when a USMCA is required? My understanding was a value of $1,000 or more. There is no requirement for having a dollar value claim. What you want to do is make sure that the duty that you are avoiding, it justifies the expense of complying with the agreement. So if you have $5 in duty that you're going to be paying if you don't claim USMCA, then it's probably not worth your time to go out making the USMCA claims. But if you have $5 in duty 1,000 times in a year, well, that can be worth a couple of hours of work. It's really a question of whether or not you want to avoid the duty. It should be noted that importing into the US, there is a de minimis rule where duties are not due if the goods are below the $800 value threshold. So you can enter goods into the US free of duties, generally speaking, if they're below that de minimis threshold. So you wouldn't even need a trade agreement to apply to that situation. So there is no specific dollar value in which USMCA can apply, but it's generally a pros and cons math. Another question here, is there a hierarchy to determining as a certifier if you are the importer, exporter, or producer? For instance, an item made at our facility in Mexico comes to the US warehouse and then is exported to Canada. When you're preparing the certification, the certifier that is signing the certification, that's the role that you should be putting on to the document. So if you have a sister company in Mexico or wholly owned subsidiary or something like that in Mexico that's doing the actual production, and then it's being imported into the US for some period of time prior to subsequent sale by the US company to a Canadian company. In that situation, if the certification can be prepared by either the US party as the exporter or by the Mexican company as the producer. Shouldn't be done by both, but the exporter needs to be able to prove that the USMCA certification that they're making is justifiable, usually using evidence from the producer. So the shipment from Mexico to the US presumably would have been entered under USMCA, and there would have been a certification issued by the Mexican sister company to the US parent company. And that justification, that proof, that evidence can be used as the basis for an exporter certification going to the customer in Canada. Or you can use the original producer certification directly for the customer in Canada without seeing like the actual nature of the relationships between the parties and what you want to share between them. It's generally custom or common practice for the exporter to be the entity issuing the certification to the customer, because that's the business relationship that they have. They expect to be dealing with the party in the US, and they want to see documentation from the US party. Just another couple of quick questions. Are you allowed to put more than 6 digits in the HS code on USMCA, or are only 6 digits allowed? You are allowed to put as many digits as you want, but anything beyond 6 digits is not going to apply to that importing country. In the US and Canada, we use a 10-digit system, and Mexico uses an 8-digit system. Anything beyond the 6 is not recognized as valid necessarily by the importing country. So putting more than 6 is not helpful to anybody, and it might put you into a tighter box depending on what sort of scrutiny that customs agencies want to apply to the certification that you provided. I generally advocate for taking on the least amount of risk whenever possible and practical, and one of those ways is to limit to the 6 digits, because you might have misclassified at the 8 or 10-digit level, and having that incorrectness on that additional document has additional exposure risk to it. But you're allowed. You don't have to only put 6 digits. Is it necessary to include the part numbers as reference of what is included in the USMCA, or the parts description is enough? Part numbers are not explicitly required. However, the description required, and we'll kind of touch on this a little bit further down when we talk about Annex 5A, but you want to be able to sufficiently identify the goods, and product numbers are the best way to do that. When you're just using generic descriptions, your good that you're describing there that is eligible for USMCA, that description may match another product that you produce or ship that is not eligible for USMCA, and that certification can be used incorrectly. It really depends on the nature of the products that are being claimed here. I advocate for putting product numbers on there to avoid that risk of misinterpretation or misapplication of the rules. Okay, I'm going to keep moving, and I'll jump back to any additional questions as we get further down into the session here. Okay, so we're talking about qualification methods. This is how we actually qualify our goods under the trade agreement. Goods are qualified according to the product-specific rules of origin identified in Annex 4B, and those methods can include either special rules, the tariff shift method, or the regional value content method. We'll look at examples of each of these so that you have a better understanding. Also recognize that there is a de minimis rule where the value of all non-originating materials used in the production that do not undergo the applicable tariff shift, when those materials do not account for more than 10% of the transaction value or the total cost of the good, provided all other requirements are met, those non-originating components can be discounted, can be ignored if they're below that 10% threshold. Use of the de minimis rule needs to be accompanied by really good record keeping, particularly on your costing process. But this is a big advantage for companies that just have a little bit of stuff that is not meeting the shift, but is included in the good because of various supply chain reasons or whatever, but is below that 10% threshold. This is a change from NAFTA. NAFTA was 7%, USMCA is 10%. I am going to advocate for thoroughly reading Annex 4A for deeper understanding of the application of the rules of origin and so the mechanisms behind them. It is a dense read, but making sure that you have a reference to that 4A before you really jump into the 4B product-specific rules. So here's an example of a special rule. These are the chemical and plastic rules that appear as a precursor to sections 6 and 7 of the USMCA. which covers HS chapters 28 through 40, basically. And there are effectively 8 different special chemical rules that can apply. And if your goods meet these special rules, regardless of the classification, as long as that classification is within those chapters, then you can be eligible for USMCA without necessarily meeting a product-specific rule. So if you satisfy any one of these rules, that results in a presumption of originating under USMCA. And if you don't meet the rule, you can still proceed to the product-specific rule at the tariff item level to qualify using RBC or tariff shift. If you're using one of these rules to qualify your products, definitely need to match your record-keeping practices to reflect these rules. Make sure that you're capturing the information that you need to have in order to defend your use of this rule as your qualification method. A lot of NAFTA practices in the chemical industries are based around the bill of materials and the product-specific rules. These new rules allow you to kind of circumvent those, and so you need to match your record-keeping to reflect those. Automotive rules are also, they have also special things. Textiles have special rules. I'm going to advocate for reading through your industry or your product specific rules and making sure that you understand how they're applied. They can get very, very complicated. Automotive rules have a 3, 4, 5-year implementation of increasing value thresholds for regional value content calculations. There's really no easy shortcut to solving some of these special rules. So I definitely recommend reading and understanding and being able to apply those rules to your goods. I won't be able to go through them here as we are moving through these. Okay, so first we're going to take a look at tariff shift. So we looked at the special rules. The next method that we can use to qualify our goods, if we don't have a special rule that applies, then we can use potentially tariff shift. And tariff shift is the transition from one article in the HTS to another article in the HTS. There's a lot of confusion around how tariff shift works. So hopefully I'll try and give you that knowledge and understanding of how to use it. But tariff shift can happen at different levels. When we're talking about levels, we're talking about levels of the harmonized classification, the HS or the HTS. And those levels include the chapter, heading, and sometimes the subheading levels. Since the first 6 stages of the HTS are universal, it's very rare to find a rule that goes beyond that subheading level, but there are always exceptions. So there are some rules in the agreement that are at the statistical level, that 7th and 8th digit levels beyond the first 6. What we're saying with tariff shift is the non-originating components of the finished good must meet the shift in order for the finished goods to be originating. The non-originating components must meet the shift for the finished good to be originating. The phrase meet the shift means a particular good has transformed at the appropriate tariff level in order to meet the origination requirements under the USMCA. We're going to look at examples here. I'm not going to talk about regional value content yet. That'll come later. But I want to kind of reinforce this tariff shift concept because it does play in through all the rules. So looking at the text of tariff shift, here are some examples that appear within the agreement. An example of chapter shift for heading 7201, it says a change to heading 7201 from any other chapter. That's considered a chapter shift. A change to subheading 7202.11 through 7202.60 from any other chapter. Again, still a chapter shift. Even though we're using the subheading level of .11 and .60, we're shifting from any other chapter. So the components cannot be classified within 7202.11 through 7202.60. They must come into those subheadings from a chapter outside of 72. Another example of chapter shift that has exclusions, moving to subheading 7202.70 from any other chapter except from subheading 2613.10. So you can have components that come from 2613.01, but not 2613.10. And those components transform into a good of 7202.70. And the reason these exceptions exist, the example I have here for 7202.70, 7202.70 is ferromolybdenum, and that's a thing. 2613.10 is roasted molybdenum ores and concentrates. So what they're saying is that you cannot become ferromolybdenum by including roasted molybdenum ores and concentrates that are non-originating. If they're coming from another country besides US, Canada, and Mexico and don't meet the origin requirements when they're mined or roasted, then you cannot just take for example, Japanese origin roasted molybdenum ore and make it a ferromolybdenum and call it originating. I should have picked an easier example than that, I'm sorry. Heading shift example, a change to subheading 7206 through 7207 from any heading outside that group. So it becomes a 7206 as long as it's not becoming a 7206 from another 7206 component or from a 7207 component. Basically, it's chapter 22 becoming a 7206. A subheading shift example, a change to subheading 401211 through 401219 from any subheading outside that group. So as long as it's not within that range of that subheading, even if it's within 4012, somewhere else between 401201 and it becomes a 401211, that means that it's going to meet the shift. And if it does not transition that much, then it will not meet the shift. So we'll look at this in a practice bill of materials here. Tariff shift example 1. This is USMCA rule on an armored safe of base metal of HTS 830300. The rule is a change to heading 8302 through 8304 from any other heading, including another heading within that group. So in this case, as long as we don't have anything in our bill of materials that is of the same heading of our finished good that is non-originating, then we should have an originating good. Unfortunately, in our bill of materials, we have 3 items. We have a safe body, we have a plastic dial on the front, and we have some screws. So our safe body is 8303. It's basically the safe, just without all the final assembly stuff. And the origin of that is Japanese. So that is non-originating under USMCA. Cannot qualify because it's not from a US, Canadian, or Mexican country. Even though we have some other components that are non-originating, like the screws, those screws meet the shift. Those screws from Mexico under 731815, those meet the shift, and those would be allowed components, but the safe body does not meet the shift and is also non-originating, so therefore our finished good is non-originating. In this example, because our safe body is in that same heading of our finished good, we cannot qualify the item. But if we take a look at a very similar example where the safe body origin is Canadian and the USMCA status on it is also originating, then we can qualify our finished good. The dial and screws both meet the shift, and the safe body does not meet the shift. So the safe body is within that rule range. It's that same heading of the finished good, so it does not meet the shift, but the safe body itself is originating, therefore our finished good is originating. So hopefully that example kind of illustrates how the usage of originating components or non-originating components couples with the shift requirement of the rules to see if the good is going to be originating. Regional value content, I'm going to kind of jump into an example here, but regional value content determines whether the accumulation of originating content meets the threshold for a particular good based on the monetary values. Basically, are you adding enough originating value to consider the end product to be originating? And there are methods for calculating whether or not you've met that threshold, and there are rules that apply to what those thresholds are. The 2 methods that you need to consider are the transaction value method, the TV method, or the net cost method, the NC method. And generally, these are both going to apply, and we'll take a look at the example, but the calculations for these are, for transaction value is transaction value minus the value of non-originating materials divided back into the transaction value, and that will give you your percentage of originating value. Your net cost method is take your net cost, subtract out the value of non-originating material, the VNM, and divide that into the net cost again, and you'll get that percentage to see where you fall. Multiply by 100 to get the percentage, but hopefully you know how math works. If the regional value content meets or beats the threshold, then the finished good is considered originating. You need to be sure to read the section heading and tariff item notes before proceeding to the HS item for qualification. But basically, if the math tells you that your good has met or exceeds the threshold specified under the TV or net cost method, then your good is going to be originating. And we're trying to effectively determine if we provided enough value to the manufacturer of these goods that is originating value that constitutes enough to pass the threshold, and therefore the whole good is considered originating. I want to take a quick second to talk about when to use transaction value or when to use net cost. The transaction value method can only be used when there is a bona fide sale and a valid transaction value price. So generally, you're looking at a sale between 2 unrelated parties. Customs has lots of rules on when the transaction value is eligible, but effectively it's an arm's length transaction between unrelated parties, and there is a substantiated and defensible transaction value for the goods that can be used as part of the calculations. And it's defensible. I may have said that already, but it needs to be provable with records to show that this is the actual transaction value, paid or payable. The net cost method can always be used, even when there's no transaction value. In fact, it must be used when there is no transaction value. In all cases, you can always use net cost because you can always add up the costs of the components into the good that went into manufacturing the good in order to do the calculations here, whereas you may not always have a transaction value in order to do the calculations. The benefit of the transaction value method is that you're able to include all of your profit in the calculations. It's basically what the arm's length price the good is. So you can get a little bit further on that percentage by including profit. But the drawback is that you're usually trying to meet a higher standard than net cost, a higher value threshold. And you can only use transaction value when you've got a valid transaction value to use. Okay, we're going to take a quick look at an example. I say quick look, this is a pretty dense slide, and I apologize for that. We're going to look at both methods in this one review, so bear with me here. We've got a B12 vitamin supplement classified under HS 300450, and the rule on that under the USMCA is a change to heading 3004 from any other heading except from 3003, or no change in tariff classification to heading 3004, provided there is a regional value content of not less than 60% where the transaction value method is used, or 50% where the net cost method is used. So this is an example of a USMCA rule that gives you both a tariff shift option and a regional value content option. In the tariff shift option, we need to have all of our components meeting the shift and being originating in their own right. So if we have all of our bill of materials meet the shift, except from heading 3003, then we can qualify our good. But if we look at our bill of material, we see that we have ground powders of 300450, which is the same heading as our finished goods. So we've got these ground powders are really providing that essential character to these B12 vitamin supplements. So we don't meet the shift. So we need to look at the regional value content portion of the rule. And we get two options here. First thing to pay attention to is that we don't need to make a tariff shift, no required change in tariff classification to heading 3004, provided there is a regional value content of not less than 60% transaction value or 50% net cost. So we look at our bill of materials, and here we've got another column on our bill of materials. So not only do we have the items on the left, the HS classification, the origin, the USMCA status, we've also now added in the cost of each of these components. And on this bill of materials, we also have a line for labor and overhead, which that labor and overhead is being performed in this case in the US, and therefore that labor is considered originating, and we get to count that as part of our net cost, so we can use that in our calculations. So the total cost of all of our materials combined is $1.50. Our sale price of the item to an unrelated party is $1.80. That's 20% profit, 30 cents. So now that we have our total net cost and our transaction value price, we can do our little math. Transaction value method, we take the $1.80, subtract out the non-originating materials, which are going to be the water and the ground powders, which is worth 75 cents. And we divide that into our transaction value, $1.80 again, and we get 58%. So even with our profit added on there, we don't reach the 60% transaction value method threshold. But we can always use the net cost method, even if our transaction value method doesn't work. And if we do the math on that, we see that we take our $1.50 net cost, subtract out our same 75 cents of non-originating materials, and divide that into our $1.50 net cost again, and we reach 50%. And our threshold is 50%. We do qualify as originating under the net cost method. Under the USMCA and most other trade agreements, you use whichever rule is most favorable to you. In this case, the net cost method works just fine when we can use that. When you're on the line like this, when you're at like exactly 50%, you definitely want to double check your numbers, make sure they're fully defensible. Most of the time, they're not going to come out to quite this simplistic of an example, but hopefully it illustrates how to use both methods and pick the one that's going to apply. And then again, if you want me to unpack this further, assuming there's time, I will do so. Certification. Just a reminder, USMCA certifications do not have a required form. They're provided on any of the document. I don't recommend using invoices as the document. The standard practice that everybody uses is to provide a secondary piece of paper that says these goods are originating. It contains all the data elements in 5A, and you're good to go on its own piece of paper. We kind of covered most of this stuff. Also under the USMCA, I do want to note that the digital certificates with electronic signatures are valid. Digital signatures does not mean a picture of someone's signature. We've kind of gotten more accustomed to it using digital signatures post-COVID and through that whole era of understanding technology a little bit better, but just taking a picture of your signature and copying and pasting it onto a document is not the same thing as a digital signature or an electronic signature. The minimum data elements spelled out in Annex 5A There are effectively 9 of them, although 6 is both HS and description. Your certifier type, your certifier's name, title, address, phone, and email, the exporter's identifying information. It's not always required, particularly if the producer is completing the certification and the exporter is not known. The producer's information, there are multiple. You can put various, or you can put available upon request by the importing authorities if you want to maintain confidentiality of who your producer is. But your producer must be in the US, Canada, or Mexico. The importer's name, address, email, and phone number. You don't always have to specify who the importer is, but I generally recommend naming the importer when it is known, otherwise putting various in there. HS description, again, 6-digit level HS is recommended. As we kind of addressed on one of the questions, it's not required to go beyond 6 digits, but that's usually what's recommended. The description must be sufficient to relate to the good that is being described so that there is understanding with customs. So basically, customs need to be able to understand that the good on the certification is the same good that's being imported, and they must be able to recognize that upon inspection and verification. And if you have a single shipment, you can put the invoice number on the certification statement or document to limit the claim to only one specific shipment of this particular good. You can specify origin criteria from Annex 4.2 A through D, B being the most common. Blanket period, I didn't cover this much, but you can only make a USMCA claim for up to a period of 1 year. So that applies to anytime you issue a certification, you have only a maximum of 1 year for that claim to be valid. And it is industry practice for that year to be January 1st of the current year to December 31st of the current year. There are some exceptions to this, but you basically get up to 12 months. But that same certification process that you're using for your finished goods, for the claims that you're making and that you're producing certifications for, applies to the raw materials that you purchase. If you received a certification in July of 2020 for eligibility, those goods are no longer eligible or considered to be eligible under USMCA for 2023. You need to get updated certifications from your suppliers for each of your originating goods that you're using as part of your qualification. Otherwise, your bill of materials, the examples that we looked at before, that column of originating would change to non-originating because your certificate is no longer valid. The blanket period being covered is no longer valid. Signatures, authorized signature and date signed, follow statement with these particular words that are spelled out in Annex 5A. I'm not going to read them. Hopefully you understand kind of what needs to go on the certification. You can provide additional stuff that's not listed here, but effectively all of these elements need to be present or accounted for on the certification in some way, whether it's on its own standalone document, whether you're attaching it or including it with other certifications or other documents. It needs to have all of these data elements. Okay, for substantiation, as we're kind of nearing the end here, you're going to need a valid HS of your goods. You're going to need to know the relevant text of the USMCA or the trade agreement that we're talking about, whatever the case may be. And you need to be able to provide substantiating evidence. Ask yourself the question, how do I know if my components are originating? Just knowing is not sufficient. You must have the evidence in hand at the time the claims are made. If you don't have the evidence in hand, you can enter the goods, pay duty on them, and then you have up to 1 year from the date of import to get that duty back if you are able to later determine or obtain the documentation that you need. So there is a provision within the USMCA. You get a year of grace period to get your money back. Asking for money back from customs agencies is not as easy as not paying it in the first place. I get that. But if you make a claim and you do not have the evidence in hand at the time of the claim, then you are non-compliant and you're subject to the penalties. Evidence can include cost of bills of materials, supplier certifications of origin, evidence of methodology for meeting those rules, certifications issued by customers or to customers or by suppliers, all of your import records for 5 years, financial verification of payments made and collected, production processes, commercial invoices. These are all things that we've had to produce to defend an inquiry or a verification request from one of the customs authorities. Participating in trade agreements will obligate you to specific regulatory requirements. It's important to recognize that you are taking on these risks. Failure to fully meet those obligations can result in penalties and loss of privileges. Methods and practices for implementation can vary widely, but any version that you implement within your company has to comply with the agreement's requirements. It's not a one-size-fits-all. There is no cookie cutter. I know that I probably have not solved anyone's actual problems on a day-to-day basis through today's conversation, but that wasn't really my goal. I wanted to kind of paint the picture of what you need to understand in order to qualify your goods for a free trade agreement, where you need to look, what information you need to have in hand, and how to apply it. For just kind of for reference, whenever I'm troubleshooting the USMCA, I like to start with the text of the agreement itself. Most people, in my experience, do not actually refer to the text of the agreement when navigating the application of the rules. They'll start with the HS classification, or they'll jump straight to the general notes segment and the product specific rule. I like to back it up further. I like to start from a higher level and work my way into an answer versus starting with the kind of last point in the chain and then trying to see if I find everything else higher than it. But I will refer to HS and cross and other places for guidance and other information. Just as a reminder, the slides and materials will be posted on our website within a few days usually. Thank you all for your time. I appreciate it.